Hello and welcome to this video. In this video, we are going to do a question from paper 4, variant 41 and 42. Both are same, May-June 2023, question 1. The question states that Barry have performed a survey of a farmer's field which is on the site of an ancient settlement. He has government permission to dig up items from that settlement and sell them to the museum around the world as long as he pays a percentage of proceeds to the government. The following information is available. ADPLC uses a system of budgetary control. Its budgeted data for 2024 includes the following. Payment to the farmer for the right to dig in the field for 4 years is $100,000, all paid before the dig starts. Estimated sales proceeds from museum is $500,000 over 4 years. Proceeds are expected to be received in the line with the progress of the dig. Payment to the government, 10% of proceeds paid in the year in which the proceeds are received. The progress of the dig with regards to the removal of ancient items and the additional associated costs are expected to be as follows. Year 1, progress of the dig is 45% and the cost is $116,500. Year 2, 25% and $98,500. Year 3, 20%, $67,000. Year 4, 10%, $23,000. Barry uses a cost of capital of 10%. The discount factor for this rate are as follows. Year 1 it's 0.90 and year 2 it is 0.826. Year 3 it's 0.751. Year 4 is 0.683. In the A-bit of the question, we are asked to calculate the net present value and PV of the digs. So let's start with our working notes. We'll start with the proceeds are expected to be received in line with the progress of the dig. And we have been given the progress and the amount of proceed was $500,000 and this is given on the basis of the progress of the dig. So in the first year, it is 45%, so 500,000 times 45%, which will be $225,000. In the second year, it will be 25%, so it will be 500,000 times 25%, which will be $125,000. In the third year, it's 20%, 500,000 times 20% will be $100,000. And in the fourth year, it is 500,000 times 10%, which will be $50,000. Next, it was given that the payment to government is 10% of the proceeds paid in the year in which the proceeds are received. So here in the first year, we are receiving $225,000 and 10% of this will be $22,500. Then it's $125,000 in the second year, 10% of this will be $12,500. And then it's 100,000, so 10% of this will be $10,000, and here it is 50,000, so 10% of this will be 5,000 in the year fourth. So now as we are done with the calculation, let's calculate the net present value. We'll start with the year and then we have the proceeds, which are the cash inflows. Payment to government is a cash outflow and the costs are cash outflow. So from proceed, which is the inflow, we will subtract payment to government and the cost. We will get the net cash flow, and we take this net cash flow, we will multiply it with the discounting factor, we will get the discounted cash flow, and when we add all the discounted cash flow, we'll get the net present value. So let's start with the year 0. We don't have proceeds, we don't have payments to government, but we do have cost of $100,000. As this is an outflow, hence this will be negative, and our net cash flows will be negative. As this is an outflow, so it will be 100,000, which will be negative, and the discounting factor in the present here will be 1, and then when we multiply this, we will get the discounted cash flow as $100,000. Then in the year 1, we have the proceeds as $225,000, and from here we will subtract the payments to government of $22,500 and the cost, which was given as $116,500. So when we subtract these two from $22,500, we'll get the net cash flow as $86,000. We will multiply this with the discounting factor of 0.909. We'll get the discounted cash flow as $78,174. In the same way, in the year 2, we have the proceeds of $125,000. From there, we subtract $12,500 and $98,500. We'll get the net cash flow as $14,000. We will multiply this with the discounting factor, which was given as 0.826. We'll get the value as $11,564. Then in year 3, we have proceeds of $100,000 and the payment to government is $10,000, which will be subtracted. The cost, which was given as $67,000, will be subtracted. Then we will get the net cash flows after subtracting 10,000 and 67,000, which will be 77,000. From 100,000, we will get the value as $23,000. And then we will multiply with the discounting factor, which is 0.751, and we'll get the discounted cash flow as $17,273. And in the year 4, we have the proceeds of $50,000. From there, we subtract $5,000 and we also subtract $23,000. We'll get the net cash flow as $22,000. The discounting factor is 0.683. When we multiply this, we'll get the value as $15,026. Now let's calculate the NPV. How do we get it? We will total up the discounted cash flow column to get the net present value, which will be our NPV, which will be negative 100,000 and plus $78,174 plus $11,564 plus $17,273 plus $15,026. When we total this up, we will get the net present value as positive $22,037. And for the third bit, let's add this column as well, that is net cash flow, where we have minus 100,000 plus $86,000 plus $14,000 plus $23,000 plus $22,000. We'll get the total as $45,000. And in the bit 2 of the question, we are asked to find the payback period. Payback period will be the period in which we get our initial investment back. Here the initial investment was $100,000, and in the year 0 we are paying this $100,000, so this will be negative. In the year 1 we have the net cash flows of $86,000 and we are able to pay this $86,000 from $100,000, so we'll be left with $14,000. Then in the year 2, we have the net cash flows of $14,000. So this $14,000 will be completely paid in the year 2. So our payback period will be 2 years. In the third bit of the question, we are asked to calculate the accounting rate of return, which is ARR. And accounting rate of return ARR is equals to average profit divided by the average investment times 100. The average profit will be the total profit from the project, which will be the total net cash flows, which we have calculated in the second bit of the question as $45,000, and divided with the life of the project, which is 4 years, we will get the average profit as $11,250. The average investment, we have the initial investment, which is 100,000 divided by 2. We don't have any scrap value, so it will be 100,000 divided by 2, which will be $50,000. And now our accounting rate of return will be equal to 11,250 divided by 50,000 times 100, which will be 22.5%. In the B bit of the question, we are asked to advise Barry whether or not he should go ahead with the dig in the farmer's field, and we have to justify our answer. You see, when we calculated the NPV in the first bit of the question, we got a positive NPV of $22,037, and NPV is a very reliable method to predict the financial gain which a project can bring to the company. So based on this, we have a positive NPV, and this will be financially beneficial to Barry, so hence he can accept the project. Apart from that, the payback period was also very short, that was 2 years, so the risk of getting back the initial investment is also low. So based on this also he can accept the project. And ARR was also quite high, that is we got the accounting rate of return as 22.5% and the cost of capital was just 10%, so there is a difference of 12.5%. So as we are getting excess of ARR, this will be financially beneficial if Barry take this project. However, he should consider the uncertain factors like the quantity and the conditions in which the items may be digged up, and whether or not the museum will be able to evaluate the price appropriately, because these may be the unique items and museums may have limited funds, so they may not be able to pay for these unique items. And even it require additional cost to transport these items from the farm to the museum, and these items may be fragile and they have to be transported to the museum in the original condition, so this may require an additional cost. So these things should be considered by Barry before going for this project. However, what I advise Barry is to go ahead, because this is financially beneficial project as well as it is a short term project, because they are getting the payback in a very short term period. So based on all the financial requirements which we have calculated, this will be financially beneficial to Barry. Hence I suggest that Barry should go ahead with the dig in the farm field. In the C bit of the question, we are asked to state two disadvantages of ARR for investment decision. You see, in ARR, we calculate the return based on profit, and profit is subjective in nature because this profit depends on the company policy. One company policy may be that they will calculate the depreciation on straight line method, and the other company may calculate the depreciation on the basis of reducing balance method. And like one company may calculate the inventory based on FIFO method, other may calculate it based on LIFO method. So when we follow different methods of calculation, the profit may also differ. So this may not be an appropriate method to compare the projects taken up by different companies. Hence, this is the drawback of ARR. Furthermore, ARR do not consider the time value of money. When we do not consider the time value of money, what happens is that we may not be aware of the present value of the future cash flow, because we may consider all the cash flows based on what the present value is. However, future cash flows will have a discounted value which is not considered when we are going for ARR method of investment valuation. Hence, this cannot be used as a standalone method for evaluation when we go for capital appraisal. And with this, we have completed this question. Thanks for watching my videos. Have a great and peaceful life.